don't think I know of one person that would have thought that when Trump got elected, that you just gut out government with no plan. A lot of stuff that you're doing is illegal, and you're messing with thousands and thousands of people's livelihood. Thousands and thousands. Whoever would have thought that? So that's why I told Ray so many times. To me, this call is spiritual. It's here to show you and to teach you and to teach us, get your financial house in order, because nobody escapes bad times.
He could mic drop on everything that he just said.
You could be my one and only. Swear we can last a lifetime. Never had a love like mine. Through the shade, girl, you still shine. From the first time we locked eyes.
This week or this month, surviving the era of Trump. Okay, we know what's been going on since the beginning of the year, and I've been fielding a number of direct calls, so I know people feeling something out there. So I said this would be appropriate to let's just talk freely about how we feel, and it really boils down to what do you do? You know, watching what's happening with the market, all the craziness, the tariffs. Our goal is the same. We're trying to build wealth, but we know we got at least 4 years of this uncertainty and everything. So that's what this week is about. We're going to talk about that. The next 4 years, what to do in light of what our wealth building goals are. And this week, a little alpha has returned. Buckle up your seatbelts. And we'll also return to a fan favorite, grifter, swindlers, and shysters. Got some for you guys. Make sure you're not losing your money, and ask us anything. Of course, we always do that. So again, on the next 4 years, it's about how we feel and everything. We'll talk about that. And we basically got 3 choices there. We'll see. And what else here? Little alpha. On that little alpha, people pay a lot of money for this segment. You get it for the grand total of 0. And wait till you hear what I got to tell you today. So we'll try to limit this to 1 hour as usual. That's our goal. Disclaimers, as always. Not a lawyer, tax accountant, or financial advisor. This content is not specific tax, legal, or investment advice. Always do your own research before acting. I encourage everybody to seek advice from licensed professionals who can evaluate your specific situation and personal needs. Please refrain from dropping and personal financial information and identifiable info in the meeting. This content is intended as helpful hints and for educational purposes only. So I want to pause right here and just hear from you all. 2 months into 2025, a lot has changed. I know a lot of people are fearful out there. Some folk are greedy. There's happiness, uncertainty, there's some depression. Y'all watching the news and on YouTube, you seeing what I'm seeing. Some folk are optimistic, but there's a lot of worry and anger. So I just want to pause here and hear from you guys. Just how y'all feeling about this environment and, you know, how it relates to this journey we've been on.
Let me kick it off. When do I start? That's a loaded question, Ray. How do I feel about this environment? Well, I think what I would say is I would start by saying, and I've mentioned this to Brian many a times, that what I'm seeing right now that's going on in the world is the primary reason why I am so glad that we do these calls. And I really wish the younger people would join them, because everything that's going on in the world now is a big reason why we do these calls, to talk about all the unexpected things that happen in the world that you have no control over in some cases, and why this information is so valuable, that you get your financial house in order. So when these unexpected things in life happen to you, you won't have a heart attack about it, for lack of better words. Because if your financial house is in order, then the pain is less. Now, who would have thought? I don't think I know of one person that would have thought that when Trump got elected, that you just gut out government with no plan. A lot of stuff that you're doing is illegal, and you messing with thousands and thousands of people's livelihood. Thousands and thousands. Whoever would have thought that? So that's why I told Ray so many times, to me, this call is spiritual. It's here to show you and to teach you and to teach us, get your financial house in order, because nobody escapes bad times. Ray and I have talked about for years all the heartaches that we've gone through to get to where we are today. And I ain't trying to say that we got boatloads of money anywhere, but if you get your financial house in order, you save, you invest, you don't do what the world do and spend your money frivolously just so you can say, oh, I drive this, oh, I live in this house, oh, I wear these kind of shoes. Don't do what the world is doing, and you will be in a better place. That's why I make it a point to join these calls. And I'm going to stop right there to let anybody else who wants to speak up.
Greg kind of summed it up. he could mic drop on everything that he just said.
You know, I was thinking about that, Greg. I know we've been talking about it. You know what I keep thinking about, y'all? And I ain't trying to be hyperbolic or melodramatic, but I've been thinking a lot about Sodom and Gomorrah, that story in the Bible during these times. I really have. The hedonistic living and partying when the market is up, nobody's saving for a rainy day, planning for the future. And then, you know, when destruction comes, people whining and crying, and it could happen to anyone. But, you know, we do have some responsibility here because of what you said, Greg. We know these days are going to come. They're going to come in cycles. And when it's good is when you have to be preparing so you're not impacted as much by, I was telling somebody, it's going to be a Trump squared in some future year in the White House. There's going to be wars. There's going to be this. It's going to be, and that's a subject all in of itself. But the impact, I'm just a big believer that you can minimize the impact that these things have. You got to do your part. And when it comes to this topic of finances and money, to me is what we talk about every time we get together, about that discipline and being smart and wise with your money. And, you know, if you don't have no emergency fund, I know you on TikTok crying. You are howling and crying, and I know, but that's why those things are important. We can't lose sight of that. So yeah, I've been thinking a lot about that story from the Bible, God, because some people, and I ain't trying to minimize it. Some people are really impacted by this, and then we also know that can't everybody have what I have or you have. We can all come in different situations, but I'm just saying, those who do, those who have had a job, those who have been bringing in monthly money for years, never save a penny, spend it all on partying and everything and travel and consumer stuff, never putting anything aside for a rainy day. I'm not backing off that. You got some responsibility here. But, so let's talk about, so we know there's people in all of the different classes. None of us, even if we're handling it better than others, we all want, everybody in this economy and this society want the conditions to improve and improve soon. But, I always look at it like, okay, I have to assume, what if this goes on for a while? It ain't going to change tomorrow or next week and next month. It's going to go on for a while. That's how I handle. So what would I do? What, depending on your situation, you know, what do you do? And that's the way I wanted us to talk about this, y'all. And I was boiling it down. I said, a lot of times these tough experiences we have in life, and many times in my life, I've faced things that tough decisions and wallowed over it. And what am I going to do? And then I think about, say, you know what, this is really simple because I only have two choices. I only have whatever, three choices, or only one option I can take. So what am I whining about? It's just simple. Think about it, make the best choice. And for something like this, I was thinking about that. I said, it's really only three options. It's only three options. You can de-risk, or you can double down, or you can do nothing. So what to do? If you're asking yourself that question, or with somebody who's going to be asking himself that question, I mean, it depends. I say, if you are working, I like to start from like first principles. I know we get into investments and all that sort of stuff, but I like to bag it up, y'all, even further than that. First principles. If you are working and at least 5 years or more away from retirement, basically you're not looking to retire right away. I say 5 years or more. That's the person who's not looking to retire right away. It's coming. But if you're in that class, a job, working with income coming in, I think you should double down. I mean, that's what I'm going to look to do. I think you should double down. Just my opinion. I ain't nobody's financial advisor, but if you've been in the market investing, and I see a lot of advisors giving that same advice, the world is not coming to an end, likely. The market's going to return. So things are on discount. They're on sale. So what does that mean? The market is going to come back bigger and stronger. I mean, history has shown that. Nothing is guaranteed, but over 100 years of history, it has shown that it always comes back. So. But let's just look at these three options a little bit. Let's talk about this de-risk thing. I want to make sure everybody knows what's meant by that. And you hear that phrase a lot from financial experts. They say, if you're concerned or the market's moving this way, consider de-risking, based on. But it's always based on your personal situation. Where you at? How you feel about what you're investing in? Where you're at in your financial journey. But what is de-risking? Let's just talk about that. So in my opinion, first, you would do this, if you are at or near retirement, as I say, at or near retirement, or maybe you feel like the world is coming to an end because Trump got elected, or you probably would consider doing this if you just can't sleep at night because of what you are investing in. All of those are legitimate reasons. You probably should de-risk if you fit in any one of those categories. So you can sleep at night. De-risking is nothing more than you just moving more of your money to less volatile investment classes, less volatile assets. That's all you're doing when we say de-risk. For example, if you're in digital assets, i.e. crypto, probably the most volatile thing on planet Earth, and you can't handle the volatility and the price swings, you should probably move some of that money to equity stock funds. That's going to be less risky than being in digital assets. If crypto is more volatile than individual stocks. An individual stock is more volatile than a stock fund. A stock fund is more volatile than a bond fund, and so on and so forth. So, de-risking is just move more money to cash, money market, and bonds. And then that's not going to swing or drop as much if this pullback goes on. A lot of people are predicting a recession. It's just a prediction. It surely looks like we're probably going to be in recession. This market is probably going to do this for a while, could be down. Yeah, if you in cash, money market, bonds, less risky stuff like that, you're not going to be experiencing 10, 20, 30, 40, 50% drops. If you have an investment account and you are in individual stocks and you want to de-risk, you're moving some of that from an individual stock to an ETF fund, S&P 500 fund. It's still a stock fund, but a ETF or mutual fund, even though it could be a stock fund, is less volatile than an individual stock. That's what you're doing. Take some of your more risky assets and simply move them to less risky assets. That is de-risking. So again, I got to reiterate, just my opinion. I'm just a guy on Zoom call. If you feel like the world is really about to burn up, you probably want to consider de-risking. If you can't sleep at night, if you're closer to retirement, by definition, no matter who's in the office, if you're closer to retirement, you shouldn't be that heavy in the very risky assets. So that's just de-risking 101. For me, I'm not in that class, and it's just me. I'm gonna tell you why. I'm in the double down class, and I just didn't conclude that 5 minutes ago. Ever since I've seen what's been happening, like everybody else, all of you, I went back and reviewed my thesis. And what I mean by that, I looked at everything I was investing in, from how much I had in ETF funds, the S&P 500, individual stocks, digital assets, and I research all of it before I get in. I really research things a long time before I do things. And I say, okay, this is how aggressive I want to be. This is how I want it allocated, what percentage I want in each investment. This is why I'm in it. I think it's going to dominate this space over the next 10, 20, 50 years. I think this, I think that. That's my thesis. Is all of that still valid? And Tracy and I have been talking about that. We've been discussing what we're in and why. And I really felt like when I did that, because see, this is the truth serum. When the market is going up and we're making those choices, I like what I'm in. Yeah, this is going to do this, and it's going up every quarter, every year. But when it comes crashing backwards, you're like, okay, did I still feel like it's going to dominate the whatever tech space over the next 20 years? Did I really feel that way? So that's what I do. I question myself. The people that I would put in this double down category is people who are not, they're years away from retirement. And to me, I mean, that number is different for everybody else. I would say 5 years or more. I said 5 years or less is somebody who's close. For my prism, I say 5 years or more. For you, it might be 10 years or more. So, but have you characterized further away from retirement? Well, you're going to stop working. You don't have new income coming in. You got to live off that nest egg, manage it well. If you're further away, doubling down could be an option if your thesis is the same. If your investment objectives haven't changed, that's the person who would look at that. The market will come back bigger and stronger. History shows it always does. So what is doubling down? Let me define it. I define de-risking. I want to talk about doubling down. I don't want to throw out terms. Doubling down to me, and remember, this is what I'm going to do. I can't tell you what to do. Doubling down is I double down on everything. If you work, I'm going back to first principles. If you can work. I know I don't have to tell this group that, but some people you got to tell that. In a time like this, if you can get a job and get money coming in, if you can work. The best economic plan in the world is not Bitcoin, it's not Tesla, it's not NVIDIA, it's not a pension. The best economic plan in the world is a JOB. First principles, people, period. Okay. If you can get a higher paying job, get it. Bring in more income. If you can get a promotion, go for it. So I start from there. The other aspect of doubling down to get right to the investing part, is, and remember your thesis. If you have decided that, yep, I'm good with what I got, or I need to make some tweaks, move some out of this investment, move others. But if you're basically staying in the market, that's the prerequisite. You've decided to do that. One thing you could do is one form of doubling down, I should say, is like in your retirement plan. Say your 401k, start contributing more. You're contributing 2%, start contributing 4%. You got 4, contribute 8%, contribute 6. Start buying more shares of what you have while the prices are depressed. The benefits of doubling down is you just walked into the department store and everything you like is on sale. And it's gonna go back to its previous high if it's a good investment, if your thesis is correct, and go even higher. So you getting it at a discount, a lower cost basis. So I say everything you have, and that's what I'm looking to do. If you got access to a 401k and you ain't in it, start it. If you've been in it with, like I say, 5% for 10 years, can you try to push it to 6% or 7%? If you got a brokerage account, and you got extra disposable income to put in there, see if you can put more in there. So that's doubling down to me, doing more, throwing more money at the market. Now I know that's going to terrify a lot of people. Might listen to this and be like, "Ooh," and that's legit. You got doubling down ain't for you. I also would make sure, I'd be remiss if I didn't say this, and this is with any one of the three options, de-risking, doubling down, or the third option. I also would make sure, while I am working, like I said, if you could work, please work, that I am paying off all consumer debt and I am building a 3 to 6 month emergency fund if I didn't have one. I mean, everybody should be doing this anyway. Sometimes I feel like, Tim, we got to start repeating that more, particularly as more people come in and listen to these, and there's more people listening to them. I want to gloss over that. That's a prerequisite even before you start investing. So as that money coming in, when you had that JOB, if I lost my job, right? Follow me here. If I lost my job, am I screwed up? Am I messed up financially as an individual? 99% of people would say yes. And I would be, because I'm in that 99% group, but if I lost my job and I had no bills or nothing to pay, am I screwed up? No, my feelings just hurt. I might feel worthless, but it's not a dire situation. And so that's what paying off debt and everything, make the impact of a job loss, a temporary job loss, unexpected bill. You can weather these storms and it just becomes an inconvenience for a little while, as opposed to you're devastated. Now you're on the way you're bankruptcy and all that sort of stuff. So emergency fund, 3 to 6 months emergency fund, pay off all that consumer debt. All right. Oh, and before I leave on a double down, I want to talk about this. Let me talk about what you're looking at here. This is important. So this is a little chart here. And this is why people double down, because people know this. The average retail investor don't know this. They don't look at charts and history. And y'all know I do that stuff all the time. So this is the market. This depicts the market performance and economy over whatever this is, 80 years or something. These little burgundy lines here, that's when we had a recession, right? So a pull down market was typically down. This is when the economy was expanding. The market is going up, the teal or blue up arrow. So right now, if you're just glancing at this, just look at this. What does this tell you? And we've talked about this before, but now it's here. And I'm trying to remind everybody to stay focused. Stay focused, people. This act has played before. The first thing that grabs me is these little down times. They're for a short period of time. Yeah, we don't like them. Yeah, they feel uncomfortable. Yeah, if you got a bunch of bills and debt and credit cards, it could really give you a knockout punch. But recessions don't last forever, and they occur very occasionally. Bull run, recession. Long bull run, recession. Bull run, recession. Huge long bull run, short recession. Over and over. This was the last one here, 2018 or 19 or something. That was just a very small, brief one. But here's the summary here. Average expansion, that's when you're in the bull market, the economy is growing and the market is typically going up. The recession, pullback, market is down. The average expansion, now think in terms of markets, 69 months. That's almost 6 years that you're getting that return. What is it, 10%, 15%, 30%? Depends on what you invested in. Every year, what am I going to make this year? My balance is growing 6 straight years. Recession comes, on average 10 months. There's been some, there's been 15 months. A lot of times it'd be 3 or 4 months. On average, just 10 months. Okay? And this just shows the growth of the economy during that long bull expansion. And when it does pull back, that's the amount. So I'm always looking at this, and I look at other charts to remind me that we've talked about before. These things come in cycles. We know how it's going to go. What's happening here in 2025? When it's done and we're expanding again, it's going to end up looking like some little skinny down line like this, right? And I tell you, I don't know about you all, but this young man right here, I'm telling you what I'm going to do. I'm going to be buying all the way down. Everything I got, I'm going to be buying it all the way down at cheap prices. Then when it snapped back, I'm expecting good times to be here. All right.
Okay. This graph you got up here is very interesting. And I think everybody that's on this call remembers that what Ray just talked about, we talked about on a previous call. That's why I say these calls are spiritual, okay? Back in 2010, this crash, if I'm not mistaken, was due to the housing market that crashed right around 2008. They was doing all that predatory lending. In 2020, it was COVID. And I think you guys probably remember when COVID hit, the gas prices went way, way down. And I said to myself, I should buy some stock in one of these oil companies and put a ton of money in it because I knew it was going to come back, just like Ray's graph is indicating. And my dumb butt did not do it. Okay. So now here we go again. Trump comes in and create a chaotic situation for everybody in the world. Okay. Even the markets don't know what to do. One day he wanted to hit Canada with a 25% tax in China. Next day, no, let's wait. Okay, it's back on. Let's hit them with a tax. Let's wait. The markets are going crazy right now. They don't know what to do. I remember there was a quote from Warren Buffett that I made that said, when others are fearful, be greedy. And that's what Ray was basically just saying. While these markets are going down. Now, I ain't saying anybody else has to do what Ray doing. He's speaking to his own personal situation. For lack of better words, he's being greedy while this market is going down. Okay? And when others are greedy, be fearful. We're living this right now. And we said it on one of the previous calls. So I just want to put that out there. That we don't know. There's still a lot of things that's going to happen. Unexpected things that's going to happen during Trump's presidency. How bad is the market going to get? Nobody knows that. Nobody knows it. But we know that things are on sale right now. And if you're in a situation to double down, you might want to consider doing it. Although I want to put it out there again, everybody's financial situation is different. If you can afford it, I'm just saying, like Ray, you might want to consider it. If you cannot afford to take the risk, then don't.
Yeah, thanks, Greg. No, that's exactly what I'm doing is that, because you say that, I was thinking about that, you said that just about the end of every meeting. That could be our closing thought about the fear and greed. So as a matter of fact, let me come out of this. I want to show you all something here. 2 things. Before I talk about this, I'm gonna tell you what this is in 1 second. But when I did my own analysis about, okay, what we're invested in, do we feel the same and all that? The other analysis I did is I've been looking really hard at the administration and what they're doing, why they're doing, and all of that. I analyzed that too. And one thing I told myself, I said, just as quickly as, a president of the U.S. can crash a market, by the things they say. Because, aside from tariffs, they have taken act on tariffs. But basically, when he just speaks, the market is flaky, finicky. It just responds. You got to be a steady long-term investor. So he could announce coming this Monday that, I'm going to cut the tariffs in half. The market will jump up and go crazy. It would be up so big. Just on that. The war in the Middle East and Russia and Ukraine comes to an end. The market is going to jump up. So what I'm saying is it could turn on a dime just by one person's decision, right? I mean, these are not structural things that's going to take years to undo. So that's another thing that made me think, let me be cogent and steady and think this through from an investor standpoint. I ain't talking politics. We could do another talk show on that. I'm talking about investing. So I looked at it both, the geopolitics as well as, how I was investing. But Greg, you always say that. And again, I hope it doesn't fall on deaf ears. Everybody nods their heads. Everybody say, yeah, I've heard that. It comes from Warren Buffett. Even the experts on TV, they mention it all the time. But you can actually measure that. You can measure fear and greed. Okay. And again, just for the record, so everybody knows, Buffett is famous for saying, be greedy when people are fearful, be fearful when people are greedy. In other words, when people are panicking at times like now, selling their stock, get out the market, you see the market going down. If you're a long-term investor, that's really when you should be buying like crazy. You should be greedy. You should buy more than you normally would. When everybody's greedy, they throwing darts at the board and their stock is going up and they know nothing about investing. That's when we're at extreme greed and a big pullback is right around the corner. And that's when a lot of people de-risk or pull out the market. So, I just don't talk about these things and listen to people. I do listen to experts, but a lot of the stuff I analyze, they can be measured. What you're looking at here is the CNN Fear and Greed Index. Everybody looks at this. So they literally look at this, and you can see right now, this is current. This is not hypothetical. This is current as of, I think, Friday. So everybody watching like, it is time to buy. It is time to start stocking up. People are panicking. People getting out. They look at indicators like this, right? So this index is a way to gauge stock market movements and where the stocks are fairly priced, okay? The theory is based on the logic that excessive fear tends to drive down share prices and too much greed tends to have opposite effect. See, we are retail investors. Most retail investors don't know what they are doing. The big money, the institution of the suits, the Wall Street, they are manipulating the retail investors. They know most retail investors are panicking and getting out, and they're buying out, and they're picking up bargain. That's why they even have this index. That's why they look at it and refer to it all the time. I'll be following these people and listening to them, right? So how to use the fear and greed index. This is how people use it. It's used to gauge the mood of the market. Many investors are emotional, like I just said, and reactionary. And fear and greed sentiment indicators can alert investors to their own emotions and biases that can influence their decision. When combined with other fundamentals and other analytical tools, the index can be a helpful way to assess market sentiment. So plain and simple, a lot of talk, but Greg, people, they look at a lot of indicators, and this is one of the ones they check to see, is it time to employ Buffett's famous statement? Okay, when people are fearful, be greedy. Option number 3, do nothing. Do nothing. Why is that an option? Because you may have already concluded, hey, this ain't my first rodeo. I know how this go. I already like my allocations and the way I have things allocated, and I don't need to make any adjustments. Whatever, I'm 70% stocks, 30% bonds to the day I die, ride or die. And, and again, if that's what that's what you studied, that's where you want to be, you don't have to do anything. You don't have to de-risk, you don't have to double down. Just keep it rolling. So we have to say that is an option for people. That's not hypothetical. A lot of people are like that. A lot of people have been doing this for years. They say they know that's how they determine what their comfortable allocation is. So when it's way up, they don't feel the urge to tweak it. When it comes down, they don't feel the urge to tweak it. They've formed years ago what their comfortable allocation is and what they want to be in. Now, what I want to do, I showed this earlier, but since we talked a lot about investment strategy, what I'm going to do, what people could do, all the hypothetical, I really feel like at this time I want to pause and revisit some of the disclaimers, y'all. I think it's important. What you just heard is not financial advice. These are just approaches I want you to think about and consider for yourself. That dissertation that I just gave is for investors who are still working and fully in the market. And, if you're doubling down or staying put, you want to be there. This is for people who don't expect to cash in their chips for at least, 5 years or more. Their retirement is still a ways off. If you are at or near retirement, I got to reiterate this, your situation is much different than the profile of investors I was just addressing. Remember, y'all, all of our situations are different. If we all went to see an investment advisor right now, we all would walk away with different plans from the advisor. Why is that? Because our situations are different. So just consider what we discussed, do your own research, talk to your planner or advisor if you have one, and never forget about the tax consequences of investment moves you make also. That will have a big impact on what you should and should not do. I just wanted to revisit those disclaimers after that discussion. All right. That brings us to a little alpha, the long awaited. Tracy got a big smile on her face. She can hardly wait. You know what we do, hadn't done it in a while. So I thought I'd remind you all, these are, analysis of companies, where we look at and profile a company. I believe will bring outsized gains, returns in the coming years. My goal is to pick these companies. Like I say, I think they would outperform the S&P 500, outperform the benchmark, outperform the market. That's what I'm looking for, the little alpha, hence the term alpha. Buckle up. This month, Palantir is on deck. Palantir. Let's talk about Palantir. They build and deploy software platforms for intelligence communities like the military, government, and for commercial companies. They have two main products. One is called Gotham, the other one is called Foundry. So the Palantir Gotham is their software platform for the military and intelligence communities. It enables users to identify patterns hidden deep within data sets, which helps operators plan and execute real-world responses to threats that have been identified within their platform. Now, their Foundry platform is for commercial, because when they first started, it was all military and business. And this is one reason why they kind of jumped out at me. And they were doing a good business there. But obviously, there's many more commercial companies. So they found a way to make products for the commercial businesses. So, and that's their Foundry. It's their main product there. With Foundry, they offer this platform transform the ways organizations operate by creating a central operating system for their data and allows individuals to integrate and analyze the data they need in one place. Palantir is an AI play. And if you all don't know, the era we're in now is all about data and big data. Data is an asset to a company, like a stock, a gold value. They are using everything to mine it. Business intelligence is big. Those are some of the new tech jobs that are out there, and people make good money. All the companies need them. It's like you got all this data and all this information is hidden in there, and it can help us be more competitive, and do the things we need to do as a company or organization. So they make software and platforms to help bring that data together, synergize it, so people can make sense of it. As you can see here, they're on the NASDAQ. Alex Karp is their CEO. they're basically intelligence companies, data intelligence, data science, and they're in a lot of different industries. So that's the high level profile. What I want to do here is show you a video where it's going to describe the company a little bit more.
Most investors don't really understand what Palantir does, the science behind this stock. And when people don't understand what they're holding, they're much more likely to panic sell. So if you've seen my previous videos covering Palantir, you already have a huge leg up over other investors. And if you haven't, let me put things in perspective for you as someone who was lucky enough to work with Palantir's employees and use Foundry in the past. Palantir's Gotham and Foundry platforms enable data science across large organizations, Gotham for governments and Foundry for commercial companies. The big idea here is to give everyone from executives and engineers to salespeople and human resources a consistent, real-time view of their data based on their role, their goals, and their permissions. Doing that helps everyone in an organization make better decisions faster, since people in different roles and departments will see all the same data instead of using different sources to piece things together from scratch. Palantir enables this by helping companies create digital twins, which are also called ontologies. At a high level, an ontology is a map of things and their relationships, kind of like a social network. In fact, let's use Facebook as an example. Facebook is a network of people and their relationships. Most people have a name, a birthday, a home address, a school or a workplace, and maybe a few hobbies or interests, all of which are different ways that people can be grouped together. For example, everyone with the same workplace is a coworker. Everyone with a nearby home address is a neighbor. These are meaningful relationships because you can do things like advertise a work function to everyone with the same workplace, or advertise a local event to everyone within a certain radius. You can also use combinations of properties to make assumptions about these relationships. For example, everyone who went to the same school and has a close enough birthday were probably direct classmates. So having a network view of all this data, or an ontology, could be useful in many different ways. For example, what if you want to find the people with the most influence in any organization, like a workplace, a school, or a new potential customer? Well, you probably want to market your service or make your campaign promises to the people with the most connections, since they can help spread your ideas the fastest. Seeing enterprise data from this ontology view can also reveal all kinds of valuable insights. Which servers in a data center are connected to the most devices, and do all those devices have the right permissions? Which military assets have too many tasks, and which ones have too few? Why does one executive have 20 direct reports while everyone else has 10? Where are all my trucks, my shipping containers, and inventory right now? This consistent, real-time, company-wide view of everything everywhere all at once can help decision makers spend time, money, and human resources as efficiently as possible. Representing data as an ontology also works no matter the size, the speed, or the type of data. Ontologies scale all the way up to entire government branches and all the way down to individual rows.
So that was just a little bit more information about it. I gave you the profile of it. So now I want to just tell you why Palantir is on my alpha list. Why is it on my alpha list? First, let me say this. Palantir is not for value investors. You know, the PE, the price earnings ratio, is really, really high. And that, the PE is one way people say, is this stock overly priced, underpriced? It looks overly priced to the average investor. So if you're a value investor who looks at PE, it's not for you. That will scare you off. We are in the beginning of the AI revolution, right? So Palantir is expected to be a cornerstone in the revolution for the next 3 to 5 years. There's no doubt in my mind about that from all the research I've seen. I mean, they're already there. Now, AI is big. Everybody don't know. The world is moving past people. They don't know AI. If you don't, because you know it's the next big thing. Right now, it's a $400 billion market. It was in 2024. Within the next 10 years, it's expected to be a $3.5 trillion market. That's the market size will grow 8x. That's more than computers, the desktop, the laptop, the internet, the mobile. I mean, that's going to grow fast within 10 years. Now, is Palantir going to get all of that? No, but they're going to get most of it because they're going to be one of the winners. When they say winners take all, winners don't take all, winners take most. Many of the companies that are building the next generation AI apps are not even publicly traded yet, but Palantir is. That's another reason why I put them on this list. We have an opportunity. We could get into it. And most leading tech companies today, and in the past they used to go public sooner, but today when they study most of the leading tech companies building most of the cutting edge transformational stuff, these companies that will be the next Apples, the next Googles, the next NVIDIAs, they're waiting on average 10 years or longer to go public. So the average retail investor can't get in. This is just another reason why Palantir presents this interesting opportunity in my mind. I'll say it again. Palantir is a public company that we can buy directly into or via ETF now if we want. I mean, I keep talking about less than 2 years because one thing I learned about investing, when you're trying to find that next Apple, that next Google, whatever, we all say that all the time. Oh man, I wish I would have been there in the first. I've learned that's what I've been looking for ever since I got more serious about investing. What's that company that's 2 to 3 years in that we're gonna look back and say, I'm gonna look back and say, wow, they dominate the market now. And so I've kind of circled Palantir as potentially one of them. Here's another reason why I put it on the list. There's this thing called the Rule of 40. This is another one of these metrics that people use. Palantir is, I'm going to introduce one other new term, SaaS, S-A-A-S, SaaS, S-A-A-S, software as a service. That basically means, when you get your softwares in the cloud, they send it to you, you're not buying it off the shelf the way we used to. So all the tech companies are like that now. So this Rule of 40, you can use with any company, but they particularly use it with SaaS companies, these tech companies, these big tech companies, because a lot of them have that high PE. So the average investor won't look at it. So they're looking at other ways to analyze them. And this is one. The Rule of 40 basically says add the company's revenue growth to their margin. And if it's over 40, this is a top company and will likely outperform its peers going forward. Okay. Again, it's a metric used primarily in the SaaS industry, software as a service companies, to assess the company's financial health by adding this revenue rate and profit margin. A combined score of 40 or higher is considered healthy, indicating a good balance between rapid growth and profitability. The key point about the rule of 40 is this revenue growth, that combination of revenue growth and profit margin. That's what people are looking at to see is it over. Very few companies get over it. So you're in rarefied air when you see companies there above it. Remember that Rule of 40 is the company over 40. A score above 40 suggests a company is effectively balancing growth and profitability. This is really what got me all over Palantir. I looked at everything else. Good. Billions, AI, they're the leader there. They brand new to you. Good. And then I was studying this Rule of 40 because I hadn't heard about this before. And I was really studying it and analyzing it. This Rule of 40, they just computed it for Palantir. Palantir's Rule of 40, their score was 81. 81, which was like, everybody's been jumping. There's one reason why everybody's been jumping. That's like unheard of. It's just like stomping us. It's like there's nobody in second place, So they're obviously significantly exceeding that 40% benchmark, which is considered healthy for a SaaS company. For comparison purposes, some public companies that have consistently beaten the Rule of 40, you might say, well, who can we compare them against? So I can put this in perspective. Big companies like Amgen, the pharma, Microsoft, Meta Platforms, Google, Apple, and those are the ones who have consistently beaten it. And other companies that have beaten it in the past is Amazon, CrowdStrike. So they're in rarefied air. And that Rule of 40, that's something I really put in my back pocket to know, is this one of those few companies that's going to outperform all the rest. Here's some of the other top SaaS company, and you can see their Rule of 40 score. These are great scores. Most people investing in, they're outperforming the market. You might not know some of these names. I know them being in corporate. I work with Viva every day, ServiceNow every day. People in marketing, the business, you have to have that stuff. Shopify, everybody's heard of Adobe. Remember, I said Palantir's score is 81. Okay, so let that sink in. So why I like it? I believe that Palantir will be one of the biggest AI plays in the coming years. I mean, like I said, they already are. If they will, but that market is still growing. It's going to grow truly big. Remember, they will dominate players in a space that's expected to grow to $3.5 trillion. They're going to get most of that. Their total addressable market is infinite. That's who they can sell to. We always look at that when you're looking at companies. You know, who is your market? Because if you can't sell to that many people, then you can only, even you got the best product on earth, you can't go that big. So the fact that they sell to military and government and a commercial, they really have no real competition. Their revenues are growing fast and the margins are expanding, guys. So that rule of 40 score of 80% just blows me away. They are outranking companies, you know, the Amazons, the Microsoft. Those are bigger, more mature companies. This is perfect. I want who's going to be that new big dog on the street. The other reason why I like it is that big money likes Palantir. Big money likes Palantir. How do I know that? How do I judge that? Because Palantir is in over 290 funds, you know, mutual funds and ETF funds. So that means the big money has tagged this, okay, yeah, we need some of this action to make our funds grow for our investors. And what you're seeing here, this little chart here, if you can read it, these are just some of the top ETFs in the world right here. And you can see they all have an allocation to Palantir. I mean, like I said, it's over 290. I just grabbed some of the top ones out there. The S&P Spider, S&P 500, I mean, you know, that's the largest ETF fund on the market. So my opinion, where I'm going with this, what I believe in 7 to 10 years, I see this stock 10xing from where it is today. Do the math, put 1,000 in, that's 10,000. 10,000, that's 100,000. I'd say 10xing in 7 to 10 years. Now, you might say that's the big stuff you're talking there, brother. Well, let me tell you a little bit here. In the summer of 2023, it has already 6x. It has 6x. And that's when I started following it. When I was doing this, I said, I'm going to do a little alpha, talk about Palantir, give it to the group. And so for this meeting, I was preparing. And I was looking at all my documents and searching for stuff. And I saw I had some Palantir stuff. And I saw that in 2023, when I was looking at some companies, I had already did a profile study on. I never shared it with you guys. I'm just doing it myself. I just looking what's out there, which I'll be looking at. And I was looking at all of that. I could not believe it. And I was like, man, that was just a year and a half ago. I don't want to look back 10 years from now, 20 years from now, and say what everybody always says about Microsoft and Google and Amazon. Oh, look, what would happen? Look how the stock has grown. I wish I would have got into it 10 years ago. 10 years is now. 10 years is now. Here's a little alpha. If you that person who buy individual stocks, you know, I'm giving you a chip to put on your table. So I like to find these companies early and get in and just slowly DCA, slowly dollar cost average, put a little bit every month, knowing where I believe it's going. I hope it gets there. But a little bit about when I looked at that document, y'all, then I'm going to move on. August 26, 2023. That was the middle of the summer. So it got on my radar in August. More people started to talk about it, had studied it. 1 year later, August 26, 2024, 1 year later, it had a little more than double. It went from 14 to 30 bucks. And in case you didn't know, it had closed this Friday, not even 1 year, it's been 6 months, at $86. It went from $30 to $86. And that's why I say when it got on my radar at 14, now it says 86. That's a 6x in a year and a half. And I believe it's going to do more than that in the next 5 to 10 years, as I told you. So they're on my radar. Individual stocks is not for everybody. I take a little bit and throw it there over time, see what happens. And there you go, Palantir. I just made all y'all rich. Thank me later. All right. Last topic, scam of the month. Grifters, swindlers, and shysters, backed by popular demand. This would be real quick. You know, we could just do 2-hour meetings on all the different scams every meeting. But I say I'm just going to refresh you guys' mind a little bit on a couple of these. I got a video. This video is 2 minutes. 2 minutes. and then we'll be wrapping it up. Again, this is unpaid tolls text scam. Everybody has gotten this multiple times. My kids got it. They don't even drive. They ain't got a toll pass. But here's a synopsis of it.
Welcome back. Beware, in their latest attempt to make a quick buck, scammers are now using EasyPass as bait. News 12's Marissa Santorelli has tips on what to do and not to do if you get a weird text.
From spam calls to scam texts, it never ends.
I've received them on my phone. Everybody seems to be receiving them.
This is the latest scheme. It might look familiar. A text claiming to be EasyPass asking you to cough up your account balance or pay a fee. But the New York State Thruway says this isn't a text from EasyPass. This is.
Please be aware of a smishing attack impersonating EasyPass New York.
And we're getting calls and emails and posts on our social media pages as well.
So I took to social media to see just how many people got the alert. The response? Overwhelming. More or less, these were your responses. Tracy says, yes, I did. Automatically blocked the number and deleted. Really smart on her part. Veronica goes on to say she received one and she doesn't even drive. She simply blocked it. We got so many responses like that. It was unbelievable. Jasmine says, I got one too, but I don't have a car, so that was an immediate red flag. Crazy. And finally, here we have Cynthia. She says, yes, I got 2 of these this week. I didn't click on them. Instead, I logged into my EasyPass account directly to see what was up. And that's exactly what authorities are suggesting.
Make sure that you do owe and that, you are being contacted for the right reason.
So you don't fall into the trap. EasyPass says they'll only contact you with a 5-digit phone number, 39769. It will never be international. They'll never ask you for your personal information, and don't click any links. EasyPass won't ever text you a link to pay. So if you do get a scam text,
You can report those to the FBI.
online through their Internet Crime Complaint Center. At the Alert Center, Marissa Santorelli, News 12.
All very helpful tips, Marissa. Thank you.
All right, y'all. That's our scam of the month. Has anybody gotten that?
I've received that text repeatedly.
I got it once or twice, and I just deleted it.
I get it 2-3 times a month. So,
Yeah. I've received it several times. I think I got one last week, actually. Good information. And thanks for the little alpha. Because we got it.
Did you get it? Did you get it?
Same day. Got it.
Yeah, and I tell you, that's where that divesting from Tesla that I was doing, a lot of it went there.
We did that as well. Well, at least I did.
She did.
Yeah.
I just ain't did it yet.
Charles is going to, but yeah, I moved my stuff out of Tesla.
I told Trey, I said, now if Tesla goes below $100 again, I'm probably gonna jump in there and buy up some and let it run back up and then get out of it again. I just ain't gonna stay, So I'm telling you ahead of time what my mind is. Every day it's changing, but I just wish he'd go head on so I can feel better about putting my money there.
I know, I agree, because I was struggling with transitioning out, but I was like, okay, I'm gonna go ahead and do it. And
But just like he said, it go under $100. Buy some up.
yeah. All right. Well, thank you.
All right.
My takeaway is keep on investing. No matter whatever scenario you pick, doubling down or doing nothing, you're still investing.
That's right.
That's my takeaway.
Right. And for the de-risker, you a de-risker?
De-risking or you're still investing.
Right, because if you're 80% in cash and 10% in bonds and 10% in stocks, you invest in 10% stocks. You'll stay right there.
Right.